Your financial freedom doesn't just depend on active work. Think about it, if your income is directly tied to the hours you work, how can you ever break free from that routine? Working until the end of your life is not a plan. That's where passive income streams come in, those income sources that keep earning for you, even while you sleep. They're essential, even if your current job pays well. But how do you build these passive income sources? It's not easy. A lot of people are still struggling to find their path. It's genuinely difficult. Even experts stumble, but you have to start somewhere. The problem? Many people don't even have initial capital. They're living paycheck to paycheck, trapped in a financial hamster wheel. Now, let's be clear. Making money while you sleep doesn't mean you won't work. It means the relationship between your time and your earnings changes. You put in the effort now to build something that will generate income later, with less hands-on involvement. Another crucial point, this doesn't happen overnight. Building a business or an investment portfolio that produces passive income takes time, strategy, and patience. Without enough passive income or a very large savings cushion, it becomes nearly impossible to build that safe nest for your golden years. If you're unsure whether you're on the right track for retirement, you're not alone. If money worries are keeping you up at night, it's time to understand how to earn while you truly rest. And remember, letting your money just sit in a bank account is rarely a good long-term strategy. With low interest rates, inflation will slowly eat away at your returns, and your purchasing power will shrink. You need to put your money to work for you. Passive income is a fantastic goal for an online business, no doubt. But it's not the only one, and getting there is more complicated than it seems. Some people think it's like winning the lottery, just pure luck, but starting a business is not a lottery. It's an investment. Can luck play a role? Sure. But what truly makes the difference is hard work, discipline, consistency. It's about showing up every single day and doing what needs to be done to move forward, step by step. That's what builds real freedom. I'm not a financial expert or advisor. I'm simply sharing what I've been learning through personal experience, research, and lots of reading. In this video, I'll show you how passive income through dividends actually works, how companies decide to pay them, and what you need to know before you start investing. Let's start with the basics. Section 01. What are dividends? Dividends are portions of a company's profits that are distributed to its shareholders. They're usually paid out quarterly, and the amount is determined by the company's board of directors based on the most recent earnings. Interestingly, some companies choose to maintain dividend payments even when their profits don't fully justify them. Why? Because a consistent track record of paying dividends makes their stock more attractive to investors. And it's not just stocks. Mutual funds and ETFs can also distribute dividends. How is dividend approval handled? For stocks, shareholders typically need to approve dividend payments. For funds, the fund managers decide, based on the fund's net asset value (NAV) and the dividends the fund itself has received. While cash is the most common form of dividend payment, companies can also issue dividends in the form of additional shares, who usually pays dividends. Typically, large and well-established companies with stable growth and less volatile stock prices are the ones paying dividends. But be cautious, an unusually high dividend yield can sometimes be a red flag, a company's desperate attempt to attract investors while facing financial struggles. It's important to understand that most publicly traded companies do not pay dividends. Why? Many companies, especially startups or high-growth firms like those in tech or biotech, prefer to reinvest all their profits back into the business. Their goal is to accelerate growth and create long-term value for shareholders. Also, just because a company has paid dividends in the past doesn't guarantee it will continue to do so in the future. If earnings decline, a company can reduce or even completely cut its dividends. How can you invest in dividends? You don't necessarily need to pick individual dividend-paying stocks. There's an entire universe of funds, ETFs, index funds, and mutual funds that focus on dividends. Some funds are designed for high yield, others for steady dividend growth, or even a mix of both. You can also explore global dividend funds, which offer broader diversification and potentially higher yields compared to US-based indexes. Becoming a shareholder, participating in a company's profits. What is a shareholder? A shareholder is any individual, business, or institution that owns at least one share of a company or a unit in a mutual fund. In simple terms, they are partial owners of the organization, and as owners, they have the right to share in its profits, rights, and responsibilities. Being a shareholder comes with important rights, such as voting on the company's or fund's strategic decisions, participating in financial success either through stock price appreciation or receiving dividends, electing members to the board of directors, claiming residual assets if the company goes bankrupt after debts are paid. But there are also risks. If the company performs poorly, the stock value drops and shareholders can lose money. Majority versus minority shareholders. Majority shareholder: anyone who controls more than 50% of a company's shares. Often, these are founders or their families in well-established companies. They hold decisive power over the company's operations. Minority shareholder: anyone owning less than 50% of the shares, which includes the vast majority of regular investors. Key rights protected by law and company bylaws. 1. Voting rights on crucial decisions like mergers, acquisitions, and electing the board of directors. 2. Participation in annual general meetings, whether in person or virtually. 3. Proxy voting: the ability to vote remotely via proxy, mail, or online platforms. 4. Access to information: the right to inspect the company's books and records. 5. Receiving dividends: if dividends are approved by the board, keeping in mind that not all companies pay dividends. 6. Protecting your interests: the right to sue the corporation in cases of serious misconduct by directors or executives. Now that you understand how shareholders participate in profits, let's dive into Section 2. Why are dividends so powerful? Section 2. Why are dividends so powerful? Is investing in dividend-paying stocks worth it for you? The answer depends on a personal financial puzzle. Let's put the pieces together. 1. Your goals and time horizon. If you're looking for steady income now and consistent growth in the long run, dividends can be a strong ally. But if you're chasing quick, explosive gains with a very short-term focus, dividends might not be the right piece for your puzzle. 2. To understand yield and sustainability. Dividend yield shows how much you earn in relation to a stock's price. But be careful, an unusually high yield can be a warning sign. It might indicate elevated risk. The key question is that dividend payment sustainable? 3. The payout ratio, the health check. Always look at the payout ratio. This is the percentage of profits the company distributes as dividends. Low payout 30 to 60%, positive sign. The company retains earnings to grow and has a cushion to maintain dividends during tough times. High payout 80% or more, red flag. If profits decline, the dividend could be reduced or even eliminated. 4. Track record is almost gold. Companies with a long history of paying and especially increasing dividends are like sturdy ships in stormy seas. They demonstrate financial stability and a commitment to shareholders. 5. Look at the bigger picture. Don't just focus on the company itself. The industry it operates in and the current economic environment are just as important. Sectors like energy or utilities are naturally more stable and reliable for generating dividend income. 6. Your risk tolerance. Dividend-paying stocks can bring some stability, but they're not immune to market volatility. The secret: diversification. Balance dividend stocks with other investment types in your portfolio. The verdict: solving this puzzle, your goals, yield, payout ratio, track record, sector, and personal risk profile is essential. If the pieces fit, dividends can become a powerful source of passive income and a pillar for building long-term wealth, paving the way to financial freedom and a peaceful retirement. Passive income: your money working for you. It's about earning money continuously with minimal effort after an initial investment of time or capital. The goal: to generate revenue autonomously. Common passive income sources in the U.S. investments: stock dividends, NYSE and NASDAQ, Treasury bond interest, T-bonds, REIT income. Digital content: online course, sales, Teachable, Kajabi, book royalties, Amazon KDP, music royalties, ASCAP, ABMI. Affiliate marketing: commissions from programs like Amazon Associates or ClickBank. Automated systems: apps in the App Store, software subscription SaaS. The essence of passive income. It requires a significant upfront effort to create an income-generating asset, but once built, it operates with minimal intervention. Main passive income categories. 1. Investment income. Your capital earns returns in regulated markets SEC. Examples: dividend-paying stocks, for example Procter & Gamble, Johnson & Johnson. Treasury securities T-bills, T-notes. High-yield savings accounts NCDIS. Retirement plans Roth IRA, 401k with automatic reinvestment. 2. Real estate income. Rental income from physical properties, residential or commercial. Investing in REITs, publicly traded real estate companies, like Realty Income Corp. 3. Passive business income. Online courses and ebooks sold on platforms. Apps and software monetized via app stores, subscriptions. Websites earning through ads, Google AdSense, or affiliate links. 4. Royalties and licensing. Copyrights from books, music, patents registered with the USPTO, licensing brands or characters. Selling stock photos Shutterstock, Getty Images. Passive income is all about building assets that work for you, an essential step toward financial independence. The snowball effect, how dividends and reinvestment accelerate wealth. Investing in dividends means buying shares of companies that distribute profits to shareholders. It's more than income, it's a powerful exponential growth strategy. Why do dividends attract investors? Predictable income, regular payments regardless of stock price movements. Stability, essential for retirees or anyone seeking cash flow. Explosive potential, when reinvested, dividends fuel compound growth, the snowball effect. How reinvestment speeds up your wealth building. Imagine this. 1. You own 100 shares of a company. 2. Annual dividend, $1 per share, $100 total. 3. Stock price, $25. 4. You reinvest dividends and buy 4 additional shares without spending extra money. Year 2. You now own 100 for shares. Your dividend increases to 100 for dollars. You reinvest again, and the cycle repeats. Year after year, your portfolio grows automatically like a snowball, gaining size and speed as it rolls downhill. The secret is compounding. It's interest earning interest. Dividends buying more shares, which generate even more dividends. Compounding is the most powerful force in investing, and reinvestment is the lever that activates it. Not every company pays dividends. Dividend payers, mature, profitable companies, for example, Coca-Cola, Johnson & Johnson. Non-payers, high-growth startups, for example, Amazon in its early years, that prefer to reinvest profits into expansion. The key criterion, a consistent track record of paying and increasing dividends, a sign of financial health and shareholder commitment. How to start your dividend snowball. 1. Select the right companies. Dividend yield, % dividend relative to stock price. Beware of excessively high yields, they may be unsustainable. Track record. Look for dividend aristocrats, 25 more years of growing dividends, or kings, 50 more years. Financial health. Stable earnings, low debt, strong cash flow. Analyze reports or use stock screeners. 2. Invest and reinvest automatically. DRIP. Buy shares through your brokerage, for example, Fidelity, Schwab. Enable DRIP, dividend reinvestment plan. Automatically reinvest dividends into fractional shares, fee-free. It's the snowball's autopilot. 3. Be patient and diversify. Patience is everything. Warren Buffett says, our favorite holding period is forever. Diversification. Spread investments across sectors: energy, healthcare, consumer goods to reduce risk. Long-term focus. Ignore short-term market noise. Let time and compound interest do their magic. Dividend investing plus automatic reinvestment. DRIP equals the forgotten strategy for exponential wealth building. Start with solid companies, activate DRIP, diversify, and be patient. Your dividend snowball will keep rolling, and your financial future will thank you. Building family financial security. When you start a family, financial decisions no longer impact just you, they affect those who depend on you. It's time to shift from quick fixes to long-term planning. Whether it's school fees, everyday bills, or the challenge of covering essentials like food and housing, stability might seem out of reach. But here's the truth. Any income level can build a secure future for your loved ones. The secret lies in consistent, focused actions. With the right strategies, you can reduce debt, strengthen savings, and teach financial habits to your children. These 10 proven practices don't require expertise, just commitment. 10 strategies for your family's financial future. 1. Realistic family budget. Track every expense: housing, food, education, transportation, subscriptions, even small luxuries. A smart budget doesn't restrict you, it directs your money to what truly matters. 2. Emergency fund. Save 3 to 6 months worth of essential expenses. Start small, even $50 a week, and automate deposits. Use it only for true emergencies like job loss or medical crises. 3. Prioritize savings. Set clear family goals: vacations, home renovations, and get everyone involved. Open savings accounts for your kids. Watching their money grow teaches financial responsibility. 4. Teach kids about money. Children learn by observing. Let them compare prices, manage allowances, and gradually introduce concepts like interest and investments as they mature. 5. Annual goal reviews. Adjust your financial plan with every major life change: new child, job, or home purchase. Align priorities with your partner, children's education, or retirement. 6. Strategic debt reduction. Focus on high-interest debts first. Pay more than the minimum, avoid new credit, and seek professional advice if needed. 7. Automate your finances. Set up automatic transfers to savings and investments on payday. Use apps that round up purchases to boost savings effortlessly. 8. Family protection. Get life insurance and create a simple will, even if you're young. Ensure your dependents are protected and designate guardians for your children. 9. Leverage tax benefits and incentives. Take advantage of tax credits like the child tax credit, family support programs, and employer benefits, health plans, retirement contributions. 10. Family financial meetings. Hold monthly meetings with your partner to discuss finances. Involve kids in age-appropriate conversations. Even the youngest can grasp saving for a goal. Conclusion: small steps create lasting legacies. Start today to build financial resilience for your family. Section 03. How to choose good dividend stocks. Investing in dividend-paying stocks is possible even if you're starting with limited resources. Whether through individual stocks, mutual funds, or ETFs, the secret isn't about how much you start with, it's about your strategy. Before you begin, make sure you built an emergency fund: 3 to 6 months of essential expenses stored in a high-yield savings account. Once you've got that safety net, explore these 3 low-cost strategies to kickstart your investments. 3 strategies for smart investors. 1. Index funds. Simplified diversification. Invest in major benchmarks like the S&P 500 with minimal fees. Many index funds have no minimum investment requirement. Charge ultra-low expense ratios. Give you instant exposure to the broad market. 2. Low-cost ETFs. Focused efficiency. Target specific sectors like tech or real estate or large-cap companies through ETFs with operating expenses as low as 0.10% per year. Flexibility to align with your personal investment strategy. Tip: always compare expense ratios on platforms like Vanguard or Fidelity. 3. Commission-free stocks. Personalize your portfolio. Use zero-commission brokers like Robinhood or Webull. Buy fractional shares of solid companies. Gradually build a diversified portfolio. Allocate 100% of your funds into the assets you choose without fees eating into your returns. Why this works: low costs keeps more of your returns in your pocket. Accessibility: start small, invest regularly. Control: choose between broad diversification ETFs or a customized stock approach. Investing isn't about how much you have, it's about how you use it. Even starting with just $50 a month can change your financial future. Top 10 investment platforms in the US. Choose the right brokerage based on your investor profile. Best overall. 1. Interactive brokers. Ultra-low fees. Largest variety of financial products. Advanced research tools. Zero-cost brokers. 2. Charles Schwab or 3. Fidelity. Zero commission on stocks ETFs. Award-winning research. Schwab. All-in-one platform. Fidelity. 3. Webull. 5. Robinhood. Zero-fee trading plus Forex Webble. User-friendly mobile interface Robinhood. Earn interest on uninvested cash Webble. Education and resources. 6. IG. Premium web platform. Best-in-class educational content. Easy deposits I withdrawals. 7. Ally Investi 8. E-Trade. Low trading fees Ally. Simplified mobile trading E-Trade. Advanced analysis tools, innovation-driven. 9. eToro. Integrated social trading, competitive fees on stocks, ETFs. 5-minute account setup. 10. Moo. Free institutional-grade analysis, zero-commission ETFs. Beginner-friendly financial education. Start investing today with just $10. Small amounts can build massive financial futures. Why start small? Habit greater than amount. $10 per week builds the habit of investing. Quiet growth. $10 weekly equals $520 per year, your first seed of wealth. Compound interest in a high-yield savings account plus for percent APY. Your money works for you. Smart planning on a tight budget. 1. Forget rigid rules. Save 20% of your income isn't realistic for everyone. Start with what you can, $10 a week or $50 a month. 2. Set priority milestones. 3. Basic emergency fund. 4. Employer for 101k match-free money. 5. Full emergency fund 3-6 months. 6. Retirement and other goals. The power of consistency. The secret weapon of successful investors. Consistency. While many chase quick profits, the real winners build wealth drop by drop. It's not about timing the market or trends, it's about steady, disciplined action. Why consistency wins. Compound interest accelerates, your money earns returns, which earn more returns. Snowball effect. Emotional protection. Automated contributions prevent emotional, fear-based decisions. Time is your ally. Starting with $300 a month at 25 often beats starting with $600 a month at 35. 3 rules for consistent growth. 1. Automate everything. Set up recurring investments even if it's just $50 per week. 2. Reinvest religiously. Put dividends and interest right back into your portfolio for exponential growth. 3. Ignore the noise. Market dips. Buy more at a discount. Market spikes. Your wealth grows. You're always moving forward. Investing is like fitness. 20 minutes a day beats 5-hour marathons. The magic is in frequency. The real payoff. Someone investing $100 a month for 30 years at 7% annual return would accumulate about $250,000, but delaying for 10 years could cost over $150,000 of that potential. Your greatest resource isn't money, it's the time your money has to grow. Start today, adjust tomorrow, but never stop. You don't need a fortune to build wealth, you just need to start. Build wealth with just $50 a month. Here's how. The beginner's strategy. 1. Start with ETFs or index funds. Instant diversification, hundreds of companies in one product. Ultra-low fees, less than 0.10% annually. Practical examples: S&P 500 ETFs VU, SPY. 2. Forget individual stocks in the beginning. Calculated risk beats random baits. Avoid unnecessary volatility while you're learning. Bonus: the power of dividends. Automatic passive income, quarterly payments directly to your account. Smart reinvestment. Use dividends to buy more shares, accelerating growth. Double benefit. Profits from stock price appreciation, profits from profit distributions. $50 month into a dividend ETF like VU could generate over $1,000 to $100 per year in a decade with minimal active effort. Why this works. Time greater than amount. Small, consistent investments plus compound interest equals huge long-term impact. Built-in protection. ETFs minimize risks of individual companies failing. Gradual freedom. Dividends create an extra paycheck to fund your goals like retirement. Your next step. Pick one low-cost ETF. Automate your contributions. Let time do the heavy lifting. If you found this video helpful, don't forget to hit that like button, subscribe for more personal finance strategies, and drop a comment below sharing your first investment goal. Your financial freedom starts with one small step. Let's build it together. Section 04. How to choose good dividend stocks. Dividends, building wealth with passive income. While traditional bonds often fail to outpace inflation, dividend-paying stocks offer both protection and a reliable cash flow stream. The investor's challenge. Finding trustworthy dividend payers requires a sharp focus on consistent profits and sustainable growth. A track record of at least 5 years of increasing dividends. Essential sectors like energy or consumer staples. Practical solution: start with specialized ETFs like SCHD or VIG, which group together dividend aristocrats, A companies with decades of uninterrupted dividend payments. Strategic advantages of dividend stocks: 1. Automatic quarterly income. Predictable payouts, ideal for retirees without needing to sell off assets. 2. Inflation protection. Annual dividend increases have historically outpaced inflation, preserving your purchasing power. 3. Dual growth engine. Stock price appreciation plus automatic dividend reinvestment DRIP accelerates your capital growth over time. Best platforms based on your goals. Beginners, Charles Schwab. Great educational resources with low fees. ETFs and dividend focused, Fidelity. Over 90% of ETFs with zero commission. Experienced traders, interactive brokers, advanced tools for deep market analysis. Crypto and options enthusiasts, Robinhood or Tasty Trade. User-friendly mobile interfaces. Companies like Coca-Cola have been paying dividends since 1893. A legacy of reliability, the real impact. A $10,000 investment in the SCHD ETF was generating approximately $340 per quarter in 2024. With automatic reinvestment, that number compounds exponentially over time, creating a powerful snowball effect. Your next move: pick a reliable dividend ETF. Automate your monthly contributions. Activate DRIP Dividend Reinvestment Plan. Let compound interest transform your discipline into true financial freedom. Section 05. The Reinvestment Strategy DRIP. Reinvestment, the engine of sustainable growth. Scaling a business takes more than expansion. It demands smart financial strategy and a relentless focus on reinvestment. Why reinvest? It turns profits into competitive advantages. Shields your business from market fluctuations. Expands profit margins over the long term. Key areas to reinvest in: 1. Technology, automation, and modern systems that cut operational costs, boost efficiency. Example: AI-driven customer service tools. 2. Customer experience, personalization, and innovation that increase customer loyalty. Position your brand as a market leader. Example: customized rewards programs. 3. Team development. Employee training that reduces turnover, fuels internal innovation. Example: certifications in emerging technologies. 4. Smart marketing. Data-driven campaigns that optimize customer acquisition. Deliver measurable ROI, return on investment. Example: hyper-targeted digital ads. The golden rule: reinvest 20 to 30% of profits before expanding expenses. Companies like Amazon and Apple followed this discipline during critical growth phases, and it paid off massively. For individual investors, the power of DRIP. Dividend reinvestment plans. DRIPs are your secret weapon. Automatically reinvest dividends into fractional shares, no brokerage fees. Accelerates the compounding effect. Important notes. Platforms like Fidelity and Charles Schwab offer DRIPs at no extra cost. Traditional brokers may require active accounts for DRIP services. Not all companies offer direct DRIP programs. Check with your brokerage. Next steps: for businesses, allocate a fixed percentage of profits into the 4 key reinvestment areas. For investors, activate DRIP on your brokerage account. For both, track and review your reinvestment results quarterly. Reinvesting isn't spending, it's planting the seeds for financial freedom. I'm not a financial expert or advisor. I'm simply sharing what I've been learning through personal experience, research, and lots of reading. Section 6. Pitfalls to avoid. 3 dividend investment risks and how to avoid them. Risk 1. Tax impact. Dividends are taxed as ordinary income up to 37% in some cases. But accounts like 401k and IRAs offer tax advantages. Traditional IRA 401k tax-deferred growth. Roth IRA, tax-free withdrawals in retirement. Solution: prioritize dividend investments within tax-advantaged accounts. Risk 2, limited growth potential. High dividend-paying companies often reinvest less back into their business. Experience slower stock price appreciation. Key stat: S&P 500 dividend aristocrats have historically underperformed high-growth companies by 15%. Source: Morningstar. Solution: balance your portfolio with growth stocks to offset slower appreciation. Risk 3, surprise dividend cuts. Dividends are not guaranteed. Companies may cut them due to economic downturns, for example, oil crash of 2020. Excessive debt, declining profits. Solution: focus on companies with a minimum 10-year history of uninterrupted dividend payments. A payout ratio below 75% of earnings. 2 fatal mistakes to avoid. Mistake 1, chasing high yields. Yields above 8% often signal trouble, declining businesses, unsustainable payouts. Real example: companies with yields over 10% had a 62% chance of cutting dividends. Bankrate study. Fix: aim for realistic yields 3 to 5% from financially healthy companies. Mistake 2, ignoring fundamentals. Never pick a stock just because of its dividend. Always check consistent revenue growth. Debt-to-equity ratio below 50%, strong free cash flow. Fix: think of dividends as a bonus, not the main reason to invest. A high dividend is like a shiny lure. It attracts, but may hide sharp hooks. Peter Lynch. Action Plan 1. Use tax-efficient ETFs like QDIV in taxable accounts. 2. Always analyze payout ratios and earnings growth before investing. 3. Diversify no more than 30% of your portfolio in dividend stocks. Dividend cuts, the red flag every investor must spot. Why do companies cut dividends? 1. Financial crisis. Prolonged earnings decline, cash flow issues affecting core operations. 2. Business preservation, prioritizing debt repayments and essential investments. Safeguarding strategic reserves, immediate impact. Stock prices drop by 8 to 12% on average. Source: S&P Global. Income investors lose confidence. Funds may remove the stock from dividend-focused indexes, for example, dividend aristocrats. 3 early warning signs. 1. Payout ratio exceeding 90%. 2. Rising debt plus stagnant profits. 3. Sector-wide cuts, for example, energy in 2020, banks in 2008. Investor lessons. What to do? Monitor payout ratios and cash flow quarterly. Diversify across sectors, no more than 20% in any single industry. Favor companies with over 25 years of continuous dividend payments. What to avoid? Buying the dip immediately after a dividend cut. Ignoring shifts in corporate governance. Overexposing to cyclical sectors. Dividends are a privilege, not a right. General Electric slashed its 116-year-old dividend in 2018. No tradition is immune. Critical fact: 90% of stocks underperform the market in the 12 months following a dividend cut. The exception: companies that cut dividends as a successful strategic turnaround, for example, Ford in 2006. Your action plan: 1. Set stop-loss orders on dividend-dependent stocks. 2. Allocate a portion of your portfolio to Dividend Kings, 55-plus years of payments. 3. Use dividend cuts as a chance to rebalance your portfolio. Diversification, your financial safety net in retirement. Concentrating your investments is like betting your retirement on a roulette spin, a gamble you don't need to take. Why concentration is dangerous: withdrawals plus market volatility equals the perfect storm. Over-relying on a few stocks amplifies risk. Key stat: concentrated portfolios are 3 times more volatile than diversified ones. 3 layers of protection. 1. Core Shield, 50-60% of your portfolio. Dividend ETFs like SCHD or VYM, instant diversification across stable companies. 2. Strategic Stability, 30-40%. Government and corporate bonds to cushion market downturns. 3. Tactical Reserve, 10%. Cash equal to 12 months of living expenses, your crisis buffer. In retirement, focus on getting your money back, not just a return on it. Golden rules. Per stock limit, never allocate more than 5% of your portfolio to a single stock. Sector cap, limit exposure to 20% per sector, for example, tech, energy. Quality over quantity. Only invest in companies with 25+ years of uninterrupted dividends, dividend aristocrats. The million-dollar mistake, overexposing to individual stocks while withdrawing monthly, is like disabling your airbags before a crash. A 30% drop in a single stock equals 10% income reduction if it's 1/3 of your portfolio. Real case, investors with 40% in bank stocks in 2008 saw their lifetime income evaporate. Today's action plan. 1. Evaluate your exposure to individual stocks. 2. Replace risky positions with diversified ETFs. 3. Automate reinvestments to build passive protection. A ship docked in the harbor doesn't face storms. In retirement, safety comes first. The short-term trap that destroys wealth, trying to time the market, is like chasing a hurricane, thrilling until it consumes you. Why market timing fails even for pros? Markets fluctuate chaotically day to day. Studies show 99% of historical market gains happen in just 7% of trading days. Trying to catch those days, it's like winning the lottery. Wall Street is the only place where people chase ambulances, hoping to profit from accidents they caused. Warren Buffett. The winning strategy: master time, not timing. 1. Embrace decade-long horizons. Markets consistently rise over 10+ year periods. Fact: the S&P 500 has never lost money in any 20-year window. 2. Eliminate day trading. Commissions plus taxes plus emotional mistakes equals 90% of traders lose money. 3. Focus on fundamentals, not tickers. Look for companies with durable competitive advantages, solid balance sheets, innovative leadership. The superpower of patient investors: compounding plus time equals the snowball effect. $500 a month at 7% annual returns equals over $1 million in 35 years. Volatility becomes opportunity. Downturns are sales to buy more. Your anti-short-term plan. 1. Automate investments, for example, every 15th of the month, no exceptions. 2. Turn off daily market alerts. Ignore the noise. 3. Review your portfolio quarterly. Focus on business fundamentals. The market rewards patience, not genius. People who plant fruit trees don't dig up the seeds every morning. Next action: pick one low-cost ETF like VU. Set up automated contributions today. Let time and discipline build your financial future. Building wealth, the art of small steps. Great fortunes aren't built on lucky breaks, they're built on simple, consistent habits. The proven formula: 1. Start small, grow steady. Investing $50 a week in ETFs beats trying to time the market. The secret: discipline plus compound interest. Real example: $200 a month at 7% grows to $500,000 in 30 years. 2. Ignore the noise. Volatility is normal. Reacting to every market swing only sabotages your gains. Is dividend investing worth it? Ask yourself 3 questions. 1. Is your goal stable income plus long-term growth? If yes, dividends can be your foundation. 2. Is the yield sustainable? Be cautious with yields over 6%. They're often traps. Check for a payout ratio below 75% and at least 5 years of consistent payments. 3. Does it align with your why? Comfortable retirement? Kids' education? Quick profits? Hint: dividends aren't for get-rich-quick plans. Dividends are like fruit trees. Plant good seeds, water them with patience, and harvest for decades. Your action plan. 1. Define your financial goal. I want $4,000 month in retirement is better than I want to be rich. 2. Pick your investment vehicle. Long-term, dividend ETFs like SCHD or VYM. Short-term, high-yield savings accounts. 3. Automate and forget. Schedule monthly contributions. Your future self will thank you. The final rule: wealth isn't about what you earn, it's about what you keep. Consistency turns daily coffee money into lifelong wealth. Start small, your first big step into investing. Fear of the unknown stops many people from investing. The most common doubts: I need a lot of money to start. What if I make a mistake? These fears are real, but here's the truth. The hardest step is simply starting. And starting small is one of the most powerful ways to begin. Investing an amount that fits your budget lowers emotional risk. With less anxiety, hesitation fades. Taking small, regular steps builds your confidence gradually, without the pressure of risky decisions. The key lies in one of the most powerful forces in investing: compound interest. It's when your earnings generate their own earnings over time. Even modest, consistent contributions harness this magic. The earlier and more regularly you invest, the harder compounding works for you. That's why starting small is so impactful. Your money grows exponentially over time. Small investments today build significant wealth for the future. Leverage apps that automate your investing journey. If you're just starting out, the right app can simplify everything. Look for platforms with low fees and easy access to the accounts and investments you need. The best apps for beginners combine: 1. User-friendly interfaces with simple transactions. 2. Useful tools and customizable portfolio options. 3. Zero commission trading on stocks and ETFs. Beyond the basics, the top beginner apps prioritize strong financial education. They offer unique resources like webinars, online courses, and educational blogs, empowering you to invest with confidence. Now it's your turn. Are you already investing? Are you building your passive income? If not, what's holding you back? Drop a comment below and tell us, when will you take your first step? If you found this video helpful, give it a thumbs up and subscribe for more no-nonsense investing guides. Turn on notifications so you never miss a step in your journey to financial freedom. And remember, small, consistent actions today lead to life-changing results tomorrow. Start now.